Hi, I'm Brian Houtz with Frazier Financial.
I'm Emily Wilcher. I'm an advisor with Frazier Financial.
We're here today to talk about the Secure Act. Many of you probably saw headlines right at the end of the year. Congress got around to passing a really major overhaul of American retirement plans. We thought we'd share some details with you today.
So, Brian, there's been a lot of noise in the media lately, a lot of different headlines and a few different versions of this bill. The final version of the bill did not actually include many of the topics that would have most impacted our clients. What are some of the items that did not make the final bill?
Yeah, a lot of the things not here are the things we were most worried about, so that made planners feel pretty good. The first Secure Act was passed right at the end of 2019, and so this builds on a lot of the themes from that original law. But some of the scarier things, like the removal of the backdoor Roth IRA or the mega Roth IRA, they are not in this bill. They remain as is. A strategy we use with clients often is converting pre-tax money into Roth money, often in retirement. That remains as is. There was no large wealth tax or no special tax on large IRAs or Roth IRAs. So no changes in how your really successful retirement accounts could be taxed. The age for qualified charitable distributions was left alone, so people can still start those charitable donations before they're required to spend their retirement accounts. There's no limits on what you can own in an IRA. Some people call this the Peter Thiel rule. You could buy PayPal in the 90s in your IRA if you'd still like to do that. They did not clarify the 10-year rule from the original Secure Act. So financial and tax planners, we still have a big question mark around how to implement that 10-year rule. Unfortunately, they didn't help us out here with this 2.0 Act. And the biggest thing that's not here is a simplification of the American retirement system. In fact, things get a lot more complex. There are dozens and dozens and dozens of provisions. They are pretty minute in many instances. You're not going to see them very often. They're not going to apply to almost everyone watching this video. So things are not getting easier, but there are some positive things in this bill for sure.
This law includes an enormous amount of new rules, and a lot of the most impactful ones are related to retirement plans and 401ks. What are the biggest changes that everybody should know?
The big changes are pretty straightforward. There's a long list of small changes. We're going to skip them for today's format. The biggest thing we feel is an increase in catch-up contributions for 401k plans. So this starts in a couple years, 2025. People will be able to contribute more money to retirement only between ages 60 and 63. So again, it's a little more detailed than the old rule, but it is an increase in what you can save. There's also a new provision. I think this will impact more of our clients than any other thing. There's a theme in these new bills lately to Rothify retirement, or some people call it the Rothification of retirement. So that did come through here. If you make over $145,000 per year, starting next year, 2024, your catch-up contributions, which will ring a bell to many of you, cannot be pre-tax. So you're going to have to put in catch-up 401k amounts as a Roth. That's going to be, in effect, a new tax for people. But in the long term, that may really benefit you. You're putting money into a tax-free account instead of a pre-tax account that would be taxed later. So we'll see how that shakes out. Another Rothification factor here is that employer matches can be done as Roth money. Again, this doesn't start for another year. This is in 2024. So 401k plans and trustees and administrators are going to spend a year figuring out how to make that happen. And that would impact mostly younger people. So a lot of the people watching this video, maybe it's your children coming out of college, their first job, they can get their match as Roth money.
Secure Act 1.0 included a huge change in required minimum distributions, or RMDs, for beneficiaries by introducing the 10-year rule and delaying RMD age. How did RMDs change in this new version?
They got delayed again. So many of you might remember they used to be age 70 and a half when you had to start spending your retirement account. Now it's age 72. This new law has started to push it back even further. So 2023, there are no new RMDs. If you turn 72 this year, you've got a dispensation. Now the age is 73, and that starts in 2023. That will eventually get pushed back even later. So in 2033, the RMD age will be all the way back to age 75.
We saw a brand new feature for 529 plans for those who are worried about oversaving or their children not using their 529s. The big picture is that you can get excess money out of your 529s. Can you tell everyone about the details about how to get this excess money out of 529s?
Yeah, the exciting new rule is that you can move money from a 529 into a Roth IRA with no penalties or taxes if you have money left over in a 529. This could also be a planning tool for those worried about an estate tax. It's going to take some time to figure out how we can best apply that. For higher net worth people, this could be a long-term tool. For most folks, this is a way to take leftover 529 money and now put it into a tax-free Roth IRA. You have to follow a couple rules. The beneficiary has to have earned income. You're limited to doing the IRA limit each year, which is currently $6,500. There's a lifetime limit of $35,000 total to be converted from 529 to Roth, and the money has to be in the plan for at least 15 years. There's still a little bit of a question mark. We don't know if that means all the money in the plan for 15 years or get $1 in the plan and all of a sudden that starts that clock. So there'll be things still here to flesh out over time, but it's an exciting new tool. We'll be talking to all of our clients that may get some benefit out of this new planning rule.
Thank you for watching our video on the Secure Act 2.0. If you have any questions, please do not hesitate to reach out to Brian, myself, or your primary advisor.
As always, our team's really excited to work with your family this year. We'll all be talking about taxes very soon. And as Emily said, reach out with any questions.